We take a look at this report. Nothing to see here. Markets are taking it in stride, albeit with a little bit of a lift at the front end of the yield curve. What's your big takeaway as you do see numbers tempering, but not exactly falling off a cliff?
Yeah, I think the big takeaway is slowing, but still a strong labor market. And I think that's why you're seeing a little bit of the bond market reaction here, pricing out a bit of that expectations in terms of the Fed, but it's pretty close to expectations, a little bit on the high side. I think the wage number is kind of the most interesting thing. It doesn't seem to be affected by the wage week. So, this is part of the strength coming into it. But I smiled when you asked the question to Stephanie, what is really the forward-looking outlook here for labor markets? There'll come a point where we'll talk about labor markets and this labor market report, and it will be validating a trend that we may be concerned about. And that will be told to us first by what's going on with profit margins. Absolutely agree with that point. It's really the pausing point that we're at here with this market report, not really moving us either confirming the concerns that we had a month and a half ago around a recession or validating the response in financial markets that, the peak of uncertainty is over. I think we're still in that uncertainty environment, and the data still that we need to validate whether or not which way that economy is going to go is still in front of us. So this is a little bit backward looking and lagging to answer your earlier question to Stephanie.
So, Jeff, let's say we're sitting here in a couple of months, and maybe payrolls growth are still slowing, but holding in somewhat okay. What would be the driving factor? Is it the reconciliation bill? Is it that tariffs are having less of an impact? What's the upside story to the economy here?
Yeah, and I think it's what you were highlighting before about whether or not this is the peak uncertainty is behind us, and its impact on decision making is not as great as we might have feared in the middle of April. And so I think that's really the determination: is what impact does all this uncertainty, which I think we still have. We haven't resolved a lot of that uncertainty. We could debate that point, but really it comes down to not what do we think about the uncertainty, but what do we do about the uncertainty? Do we press ahead and just make decisions, make investments, hiring, as if nothing had happened? Or is there a cooling effect on all of those decisions, whether they're on the business side or on the consumption side? That's what's going to drive that economy. It's going to drive the consumption side in terms of demand, and it's going to drive business confidence in terms of what we see in terms of investment. And that's, I think, what the narrative is going to be 2, 3, 4 months from now.
Well, do you think the business community will just keep treading water? How do you make those decisions? I mean, just moments ago, Peter Navarro, a trade aide to President Trump, is telling reporters that the China meeting is expected in 7 days. So in a week's time, we could be dealt with a fresh blow of uncertainty, Jeff.
Yeah, I think the honest answer is we just don't know, because the new data that's coming out, whether it's the challenges from the legal perspective, whether it's the change in terms of the negotiations, what is actually in those negotiations in terms of how much they relieve the uncertainty, we just don't know. And I think there is a cooling effect in the interim. It doesn't show up because the data is still lagged, so it'll show up in the next couple of months. So I just think we don't quite know on the trade impact.
Given the lag, do you think then the Fed is going to be behind the curve? I mean, Elon Musk, an insider who's now on the outs, was saying yesterday that Trump's tariffs will mean a recession in the second half of the year.
I think the Fed has been very clear in their communications that the headline is wait and see, and that the economy is in a good enough position where they can adopt that approach. I think if there's one thing to this report today, it kind of validates that approach, right? We're not seeing an aggressive move in terms of the slowdown impact in hiring in the economy. We're not seeing a huge acceleration. I do think there's some strength, some lingering strength there in wages, but not enough to really press on the inflationary concerns. And so the Fed's in a good spot here to wait and see. Will they be lagged? Yes, this is kind of the, impact of moving from forecast dependence to data dependence is that the Fed has to be reactive. And so they'll be lagged. The issue for the markets will be, will they aggressively catch up if they are indeed, behind the curve in the event that the trade and tariff uncertainty, leads to a bigger slowdown, then they're going to have to get more aggressive. That's not priced in to the bond market, as we were talking about. It's only 1 to 2 cuts because it's not yet showing up in the data.
I want to take a step back and talk about what you and Stephanie both brought up, that this labor market information isn't necessarily going to be as tradable as some of the earnings data that we get with respect to profit margins. And I wonder if there's something of a paradigm shift where we were so data dependent and every economic indicator that came out for the past couple of years was a huge tradable moment that was going to give some sort of insight into what the Fed would do. Is that era over? And are we now earnings dependent? Not necessarily when it comes to figuring out how much money they're making, but what companies are doing with what we're hearing about in the mess in real time in a way that this data cannot tell us anymore, Jeff.
Yeah, there's a long history to the payroll report in terms of moving the bond market. Has it lost some of its efficacy? Certainly, we've come out of this period where inflation has been the bigger driver. Clearly, that has been the story of the last couple of years. And so the payroll report isn't really the kind of preeminent data release on inflation. It has an important component with regards to wages and wage inflation, as I was just highlighting. When you think about kind of the demand side shocks that we typically associate with recessions, the payroll report can be, more confirmative on those trends and solidify the expectations for the Fed. That's where the linkages and the importance to the bond market comes from. But when the issues are more supply side, and we can kind of think of tariffs and the tariff shock as more of a supply side, it has both elements of a supply side and demand side. But when you think about economic shocks driving financial markets that are more from the supply side, yes, the labor markets kind of lose their primacy of being kind of the preeminent data release that we focus on.